Our next guest wanted a half-point cut, but expected the Fed to either underpromise or underdeliver. Now he says this is surprise good news for the labor market, small businesses, and the rally's breadth. Barry Knapp is here on set with me. He's Ironsides Macroeconomics Chief Market Strategist. You must have been jubilant. You've been saying they're way behind the curve.
I'm not sure I'd go with jubilant after 40 years of watching this. But, yeah, the crux of my argument is that they went about policy tightening all wrong. They eased primarily through using their balance sheet, and they tightened primarily through using rate policy. It caused the deepest yield curve inversion since the early 80s, something that wiped out the savings and loan industry or started the chain of events that led to wiping out the savings and loan industry. And it put the burden of weaker demand almost entirely on floating rate borrowers, small businesses, small banks. And as a consequence, if they hadn't done it that way, if they'd been more active with unwinding their balance sheet, even if they didn't want to sell mortgages outright, had they just reinvested all maturing securities into Treasury bills instead of keeping the maturity as long as they had. Steve asked Rich Clarida about this the other day, and Rich didn't offer an estimate on how much it's suppressing 10-year rates. The Kansas City Fed says it's more than 1%. I don't think they would have ever had to go beyond 4. So for 4%. Me to get to 4, correct, get that policy rate back to 4, somewhat painlessly disinvert the curve, take the pressure off small banks and small businesses, the faster they get there, the higher the probability that we avoid a recession, because to me, it already looks like we're in a small business recession that could easily spread to the rest of the economy, given that that's the foundation of the labor market.
Well, exactly. 60%. That's where the hiring comes from. And so this is one area where a bigger rate cut will actually have an immediate effect that could really lengthen the recovery and help the people it needs to help the most. Just to go back to this point about the balance sheet, some have argued, David Zervos is one, that the large balance sheet itself has been a form of stimulus as they've done rate hikes because it's cushioned the blow instead of the traditional financial system. Is it still sort of supporting the economy? Is it working against what the Fed's been trying to do? Does it matter now?
So there's 3 forms of stimulus in place and 1 form of restriction. The only form of restriction was the policy rate. We've got $3.3 trillion in bank reserves sitting in the system, something that didn't exist pre-pandemic or pre-global financial crisis, excuse me. We've got that pressure on the back end of the balance sheet, which is holding rates probably 1% lower than they would be otherwise. And we're running 7% budget deficits and government spending at 24% of GDP. So we have a very imbalanced economy because if you're a household that owns assets, policy's easy. If you're a large non-financial corporate or a big publicly traded home builder that can finance out the curve, policy's easy. If you're a small business that borrows at a floating rate and a small bank where your return on equity is half of that of the large banks, policy's tight.